Hey everyone, welcome to another deep dive. Today, very special guest. I have with me Jacob from 3Chain. Uh, Thanks for being here, Jacob.
Thank you for having me.
Yeah, so I've been kind of deep diving 3Chain a little bit. You were nice enough to give me an early access code, but for those that don't know, what's I guess the one line pitch or what's the short pitch for what 3Chain actually is, and then we can go from there.
So our one-liner is we're the first credit-based money market. Uh, Basically, what that means is you can borrow capital against the future, like against your future cash flows, and not have to put up collateral. And so it's the first in kind in DeFi.
Well, I think what people were to kind of explain the problem that I saw, would you be fair to say it's uncollateralized lending, right? This is
Yeah, it's uncollateralized in compared to over collateralized. It's still collateralized if you want to get specific, but yes.
okay. Yeah, so I guess the basics of the way that most lending protocols work right now is, you have basically lenders and they put a bunch of USDC into a pool, and then you want to borrow this USDC, you deposit ETH. So you have to deposit, say, $110 worth of ETH for every $100 worth of USDC that you can borrow out of the pool. And then as long as your ETH stays above that $100 limit or $105 for a little bit of buffer, you're fine to keep it, and then you can return it. Or
That's that's how all of DeFi
yep.
works since 2017. Yeah.
Yeah, and so I guess, how do you guys work differently? What would be
So yeah, the way it works is uh you the all of DeFi protocols so far has sort of relied on economic incentives to enforce repayment, which is if you don't repay, that's fine. We're gonna keep your collateral, but you do have an incentive to repay because your collateral is worth more than the amount you borrowed. That's what we call economic incentive. And then the other one, which has been an extremely difficult lift for a number of reasons, uh, is this idea of human will, like your willingness to repay. And the only way you could really sort of enforce that is by jurisdiction. So for us, at the very least, we're going to start in the US. And the idea is you connect your bank account and we store KYC details. And then you can just borrow completely unsecured against your Coinbase assets, your bank assets, your on-chain assets. And so your capital efficiency goes through the roof. You don't have to put up collateral um, because we basically have a sort of recourse against you in the court system if needed.
Yeah, so this is much more traditional lending, I would say. You
Yeah.
would look, if I want to borrow money for a house, I would traditionally go to a mortgage lender here, say, listen, these are my assets. Um, Most of the, I can you give do they accept Coinbase as assets now for mortgages?
No.
No, okay. So you can't do Coinbase, but you could say bank assets, and then they would look at it and then give you a loan based on that. The question would be is, I guess, do you guys require then full over collateralization? So like, do you have to have Coinbase assets to cover it?
Yeah. So that's the way it works. It's basically like imagine you have $1 million in Coinbase, 100 grand in your bank account, and like 500 grand in your on-chain assets. We would basically take a haircut on those assets that are sort of verifiable to us through on-chain proofs, and we can get into that as well.
Yeah.
We have these proofs from all these off-chain API sources and proofs from on-chain that you have X amount of assets, and then we take a haircut on it, apply some sort of multiplier based on your credit worthiness on chain and your off chain, which we can also talk about later. And then we sort of derive a credit line, a credit limit for you, and you can then borrow that credit limit completely unsecured in DeFi.
Nice. Yeah, so let's talk, I guess we'll just go into the details of how it works. Um, so first off, there's people you can deposit USDC, I'm guessing, or some collateral for borrowing. And this probably looks very, very similar to traditional lending markets, right? You come on chain and you deposit into a pool and you're expecting some reward for doing so, right?
Yeah, frankly, I think the best sort of analogy is a unsecured Aave. In a lot of senses, it is an unsecured Aave, except sort of the underwriting process is rather than enforcing collateral constraints, it's underwriting sort of your credit worthiness, and that's part of the main differentiator. But in all other aspects, it's pretty much the same. You have suppliers on one side putting
Yep.
capital into a pool, and we have a utilization ratio similar to Aave or Morpho, and then you have individuals on the other side that can borrow up to their credit line unsecured and tap into that pool.
Sure. Yeah, so let's get into how the smart contract knows to release some funds to the lender, right? I think that would be the next step.
Yeah.
So I come to 3Jane and I want to borrow some money. I give you guys my address. I have some money in there. What's sort of the next steps?
The next step is you connect your bank account via Plaid, and we're still finalizing what exactly we need to store. Like, obviously, like I have a DeFi background. I've been in crypto since 2021, and so I am very privacy conscious myself. And so I'm trying to find that fine line of what's the minimum we need to store. And for right now, we've sort of finalized on the very least your full name and your date of birth, and we're figuring out from there. But yeah, you connect your bank account, and then that's it. Pretty much from there, we know who you are, or at least the collections agencies that we work with can sort of triangulate you if need be. Um, and yeah, you connect your bank account and you connect your address, and we basically look at what's your on-chain assets, uh, and off-chain. We have like an API that derives a certain credit line, and then we post that credit line on chain, and then we also post proofs of uh, you know sort of our methodology as well.
Okay, so I would connect my bank account. I guess I don't necessarily know how Plaid works. Is this, like most people are familiar, there's the Oracle problem. So you have a smart contract and it cannot connect to your bank account, correct? So
Yeah.
how does the information go from there into the smart contract, or is this more of a trusted process?
So the way it works is you Plaid has an API, and it basically we've partnered with Plaid. We've integrated with Plaid where you can just connect to your bank account and log in. On the back end, we leverage Plaid's API to sort of retrieve your bank assets and income, and then we store that. And so that API response we wrap into a zkTLS sort of fetch function. And we work with Reclaim on that. And so that generates a proof of the provenance and integrity of that API response. And then we sort of can take bits and pieces of that that are critical for maintaining sort of trust in the system. We can post it on chain. And so that way we sort of leverage cryptoeconomic security from EigenLayer to sort of show that the data that we got from Plaid is in fact from Plaid, and it corresponds to, X, Y, and Z user without, compromising privacy, and at the same time, sort of making it trustless, which is what we're trying to do.
Yeah, no, it wasn't last episode, I think like 2 or 3 episodes ago, I had on Woofy from Opacity. And they're a zkTLS platform. So
Yep,
for
exactly.
viewers,
All the pieces are coming together. It's funny, all the
yeah,
pieces are coming together. Like if Eigenlayer didn't exist, unsecured lending would be very difficult. If zkTLS didn't exist, unsecured lending couldn't be possible. So it's really the culmination of multiple advancements in cryptoeconomic security and in zkTLS that makes unsecured lending possible in 2025.
so how does Eigenlayer fit in here?
The way Eigenlayer fits in is so there are a couple of so Opacity and Z and Reclaim, which are both zkTLS providers. They both run an AVS on top of Eigenlayer,
Yep.
and the reason why they need to do that is to basically have sort of consensus around the designated verifiers, just a fancy way of saying it's very if you try to do like prove the provenance of a certain API response, it would be very difficult to do cryptographically. It's like impossible. And so the next best thing is you do it via cryptoeconomic security. And so that's why they sort of tap into Eigenlayer to provide sort of consensus around the provenance of an API response.
Nice. Yeah, no, I was just confused. I thought you guys were using Eigenlayer more directly. Uh,
No, yeah, it's ZK. We use it
yep.
through in proxy with zkTLS.
Nice. Yeah, and then okay, so you get the bank information and it gets thrown on chain, or at least a proof that I
Some
haven't.
some parts, some the parts of it that are not really compromising about a specific individual, but some sort of trying to find the sweet spot of like what's just enough where we sort of disintermediate this as much as possible and not have any trust assumptions on 3J itself.
Well, that's like I was wondering, like if I connect my bank account and then I borrow some amount of money, can you then back out how much, could a viewer then back out how much money I have in my bank account from like the on-chain formulas?
Yeah, so uh, yeah, I mean, they would be able to get a much better ballpark
Right.
uh, of it. They would probably be able to reverse engineer it to a certain extent. They wouldn't be able to know exactly how much you have, but they'd be able to get a better sense because yeah, I mean, if you see that an address is borrowing $1 million and there's $1.1 million on chain, then you know they probably have a lot more in their bank account because otherwise they wouldn't be able to get that loan. So you could try and figure it out. Yeah.
That's cool. Um, okay, so once the data is on chain, can I instantly borrow, or is there a period for disputes or any sort of challenges
No,
on it?
it's all algorithmic. We call it semi-permission because we trying to get as permissionless as possible. The only sort of friction is you have to connect your bank account, but after that, it's like the process feels as if it's another DeFi protocol,
Yep.
where it's just immediately on the back end, we have an algorithm that in real time gets your credit line, post that credit line on chain, you can borrow immediately. So you wouldn't even know that it's permissioned, really. It's not like there's a review committee and that checks manually or anything.
Well, I guess here the risk, of course, would be if the zkTLS piece is compromised, right?
Yes. If the zkTLS piece is compromised, and the only way that would happen is if there is collusion from the operators in Eigenlayer, and the only way that that would make sense is if their sort of profits from doing that is higher than the sort of amount of restake that is delegated to them.
Well,
And
sort of, but I mean, like what I was thinking about, not that the zkTLS piece itself is broken, but like, right now, like I have a bank account. I'm not too worried about my bank password. I
yeah,
am a little bit, but like if you try and steal my money, like I can probably call my bank and get the vast majority of it back.
Yeah.
But here, like if somebody steals my bank password, could they then connect here and
Oh,
steal some money?
I see. No, because well, basically they would need to. So there is a fraud piece, and
Yep.
we have mitigated the fraud piece significantly because the point of entry is your address, not your bank account. And so basically you're first connecting with your on-chain address, and then you sort of connect your bank account to the address. And so one of the things we look at is this like our target market is farmers and traders, right? Like these are the people who are going to be borrowing initially. And those people are going to have like an extremely extensive and like deep history on their on-chain address. And if we don't see that, we're just not going to give you a loan. And that's
Okay.
how we mitigate fraud because the only way, like the intersection between farmers and traders, who we need to see a lot of history for you to get a loan, and the people who are committing identity fraud is a very small intersection. Like people who are farmers are not people who do identity fraud. We think people are going to figure it out and we'll work towards it, but we don't think it's going to be a problem in the near term.
Yeah, and then I guess the next question would be is then I guess how on that piece for the on-chain, how do you measure history? Do you do that more subjectively or is that in the code as well?
It is also in the code. So we partnered with a company called Cred Protocol, and they've been in the credit underwriting business for 3 years now on chain. And it's been very slow, but now things are starting to pick up, and I'm glad they stuck around. And so, yeah, they're trying to be like the sort of the FICO of crypto, and they're doing a pretty good job at it. So we've worked with them on the credit underwriting, scoring, to sort of assess the creditworthiness of an address.
Nice.
That's all very, very complicated in and of itself, but yes.
Yeah, no, I can imagine. I've been looking into some of that. And then once you have a loan, do you continue to monitor the person? Or,
Yeah.
like let's say I get a loan and then I transfer everything out of my bank account or everything out of my on-chain wallet because that's what the loan was based on. Um,
That is suspicious. And
yeah.
and we're still figuring out what our protocol is for those edge cases. And I mean, businesses like live and die by those extreme edge cases, so we're thinking about it very hard. But um, to answer on a high level, like for individuals, we do monitor you, and we check how many assets you still have, and then we sort of have a refresh cycle where every month we refresh your credit line based on sort of any updates. Do you have more assets now? Do you have less off assets now? Are you more or less creditworthy? So your interest rate might go down. You might get boosts in your credit line. So we have like a monthly refresh cycle.
Nice. Um, that's super cool. And then I guess, the one thing I wanted to talk about, where do you sort of see the use cases for this? Like I know one of the big reasons that you see a lot of borrowing and lending in, say, like Aave, for instance, is to go get leverage, right? Like you're going to borrow the assets, you're going to buy back the other asset, deposit into Aave again or some other protocol, and like loop these things over and over again. I'm
Yeah.
guessing you don't allow looping.
We don't
Uh,
allow looping,
yeah.
but you can do looping yourself. You can do looping, like we can be a launch pad for you to loop somewhere else, right? Like you can take a credit line that is sizable and then lever up however much you want on over collateralized lending protocols with some sort of yield bearing derivative of Ether, BTC, or whatever. So yeah, I mean, yeah, a primary use case, just as it is for Aave and it always has been for any sort of money market, is yield farming.
Yep.
Uh, and as long as the interest rate, which we've modeled and it makes sense for you to borrow at the sort of unsecured rate and still be profitable, then you'll do it. And we found that for the most part, that's true.
Yeah, no, I think that's super cool. You can allow people to start gambling without putting their own assets at risk if they don't want to sell them, I guess you could say. Uh,
Yeah, well, basically the main thing that we want to unlock is sure, there's the component where you might be conscious of putting up your collateral, but we think the sort of we break it up into a couple of categories of like the main unlocks is the idea of okay, so traditional money markets are very good at allowing you to borrow against majors or like primary assets. And like three other or four other categories that we sort of want to tackle and enable. The first is sort of off-chain collateral, quote unquote, which is I have Coinbase assets, I have bank assets, I have assets in my brokerage account. I should be able to borrow more. Like that's our tagline. Borrow. You should be able to borrow more in DeFi. Just because Aave doesn't see my assets somewhere else doesn't mean I shouldn't be able to borrow more assets. So off chain. And then the second category is sort of more exotic on chain assets that we would be able to sort of monitor and take a haircut on and enable you to borrow against, like a bunch of tail assets that traditional money markets won't let you borrow against. We can at least sort of holistically take a haircut on it in composition with your other assets. So that's the second category is exotic collateral. And then the third category is sort of future collateral, which is how we started this podcast, which is your
yeah.
future cash flows are you might have income or you might have returns from somewhere else that are sort of generating assets, and then we can let you borrow against that as well. So your future collateral. And this again, this idea of your future cash flows is not a concept that exists in DeFi, even though that's how credit markets have worked and that's how kingdoms and empires have been created is through credit, extending credit against future growth. So that's the third category. And then the fourth category is um, cross-chain assets. So you might have assets on other chains that you don't want to have to borrow on four different instances of an Aave of each, but you have them for whatever reason on Base or Berachain or whatever. And here we can see it all because it's all EVM compatible, and we can give you a loan directly in one place.
Yeah, no, that's super cool. I mean, the one piece I would say would be like, how do you sort of determine the haircuts? And is that programmatic or is this the role of some sort of governance?
That's a good question. Uh, I think initially it's going to be us. We don't have a token yet, so there's nothing really to govern, and we need to launch the protocol, to start. So it'll be us at the beginning, and I think we're going to tackle the big guys like Ethereum, WBTC, like the top 10 assets. And then from there, where it gets much more fun is doing haircuts on the smaller guys. And that can be a more, you know, um, a slower process.
Well, Aave sets collateralization limits. It's like almost the reverse of that.
Yeah.
Well,
Yeah.
I think what they use, what Gauntlet, I think or they have these firms that do all the research and
Yeah.
analysis on them.
Yeah. Gauntlet is on the Morpho team now, but yeah,
Yeah.
but yeah.
Yeah, you got to find your own, I guess, or create your own.
Yeah. Well, cred protocol is sort of they've
Sure.
wow.
That's awesome. And then I mean the first thing that comes to mind anytime anyone ever hears under collateralized lending or almost like connecting bank assets is like, how on earth is this legal, right? Like, most of the people would, anytime there's like sex lending, it's like, well, that's Celsius, right? Or something like that, and it always leads to issues.
Yeah.
Like, how do you respond to that, or say like, listen, this isn't like Celsius where you're
Yeah. Well, I mean, maybe we should give like a quick background for on myself. Like I was the founding engineer at Ribbon Finance, which was a structured products protocol, and I scaled that up to hundreds of millions of TVL. And I then spun out within Ribbon our own unsecured lending protocol, but it was exclusively institutional facing. So we're giving revolving lines of credit unsecured to Wintermute and Folkvang in 2022 in October and right before FTX. And that was one of the most stressful days of my life because Wintermute and Folkvang, they obviously had exposure to FTX because they had assets there. And so, anyways, we recovered our funds, but the point of the story is that I had a first row seat to all of the opaqueness and the shenanigans of the Celsius 3AC FTX era. And that stuck with me. And so this time around, when I'm actively thinking about how do you disintermediate and make this as permissionless, privacy focused as possible while being sort of scalable and for lenders. So that's the piece. The key piece here is we're combining cryptoeconomic security of the off-chain assets, and at the same time we're capitalizing on the like the trustlessness and transparency of smart contracts. So we're really getting the best of both worlds. There really isn't a way. We're trying to make this structure, this architect, this such that there really isn't a way for us to do anything like not legal, even if we wanted to. And like the fact that everything is on chain makes this much easier
Yep.
because it's much easier to see. Anyone can really sort of sanity check, okay, what's going on, and there is any anomalies in terms of who's getting funds. But anyways, the point of the story, there is a way to structure this in a way where you get unsecured lending and you are transparent and legal.
Yeah, because I mean, like the way that you would set this up, like if you were completely, if you didn't want to set it up on chain, you could easily just set up a business that says like, connect your bank account, connect your crypto wallet, and we'll give you USDC to whatever address to your address. Like, and it doesn't even have to be on chain. And Coinbase could run this program.
Yeah.
Um, I guess and this is like who this is probably the discussion over the Trump era. It's like which one of those structures is going to win? Which one, where do you sort of see the regulatory environment going such that maybe on-chain will win? There's like we want to go on-chain, zkTLS, completely, crypto economic security to the max, or there's like we're going to go require you to register at the CFTC.
Uh,
And there's like those two paths.
I mean, we're generally very bullish like on in a macro trend, we're very bullish on decentralization and smart contracts, especially as agents come onto the scene, because the main reason why historically sexes have outperformed is because of the custody. Like people don't want it custody. And we can talk about this later, but basically, if agents are going to be doing everything in 3 years, then all that matters is what's the most efficient, what's the most practical. And I think this centralized model is going to die out because it's much less efficient. So that's my general thesis. And that's sort of driven my thinking of how to structure 3Jane itself.
Well, I mean, what chain are you guys on? You guys are on.
So we're still figuring it out.
Okay.
We want to structure this some structure between Ethereum and Base. We're still figuring it out.
Yeah. No, it's because like that on the efficiency piece, like with the sexes, that's the pushback you'll hear from the sex people is like, well, like Ethereum's 12 seconds, like we
That's
can be slow at certain times, but like the vast majority of the times we're an API call. And, hooking an agent into doing a Coinbase trade is also just as easy.
And there are ways of, in a modular architecture, there are ways of getting those benefits from speed and efficiency, while also still maintaining some of that security from the base layer. But at least for our use case, it's not as consequential because lending is not a latency constrained financial interaction. And so it doesn't matter for us as much. But generally speaking, you're right.
Yeah. No, and I guess that was like my pushback on the centralized piece, but then you also will probably hear arguments from, say, like the decentralization maxis or like the Aves of the world will say this is too trusted. This model relies on things such as reputation. It relies on um, it actually favors people with bank accounts, things like that. Um,
Yeah.
yeah, like where do you see the balance?
I mean, uh, it's look, in a perfect world, if we want to stick to this decentralization line, we would stick with something like liquidity, right? And then we would call it a day. But
I like
it's
liquidity.
I,
I like liquidity.
I do too. I do too, but it has its own problems in terms of scaling.
Sure.
And if so, that's like the constant push and pull within DeFi. Like, how much do we want to financially innovate, and how much do we want to sort of BTC, borrow against BTC and call it a day? Like, where do we want to draw the line? I tend to be on the former side. Like, I'm a financial innovation maxi, and if we're breaking some rules here and there, like that's fine as long as we're making them consciously and know the trade-offs.
Yeah, no, I think it's going to be interesting. It's always just the more you go down this path, like it's to me it seems is can decentralization or decentralization maxis ever compete with the centralized piece? Because there's like a thin line between like you go from Liquidity to Aave to 3Jane to the Coinbase lending. And it's like where on the path do all of these exist at the same time? Is there a winner take all model?
I think agents actually change this fundamentally because the points of centralization, like the main argument against Aave, or it's going to happen for 3chain as well, is there is a point of centralization because you have some sort of off-chain logic that enables the protocol to exist. And that off-chain logic is largely a human-centric process. And if you can disintermediate that fully with agents, then you end up getting the best of both worlds because you take humans out of the equation, but you're also unlocking a new level of financial innovation by involving off-chain logic. And that's the way I think it's going to work, where like in the case of Aave, they're already experimenting with this, and the sort of the LTV ratios or setting certain risk parameters are all going to be sort of autonomously driven by agents and AI logic.
But like for you guys, I mean, what does it look like with an agent using 3Jane? Like if you had even in the future, like where's the bankruptcy law on an agent? You know,
Oh, you mean as a borrower? I was meaning as the sort of the
as,
underwriter.
as the underwriter.
Oh, well, I mean, I'm glad you brought that up
Okay,
because
please.
I'm extremely excited about, I think the end game for 3Gen is lending to agents. I don't see how, like, based on where the world is converging, I don't see how that's not going to be how the way the world works in 3 to 5 years. And so I just want to be actively positioned for it, where the main economic, the primary actors for taking out loans, either on behalf of their own business or on behalf of a mega core, is going to be agents. Like that, those are the ones who are going to be taking out the loans. Um, so yeah, we're thinking about that actively right now.
Yeah, no, it just I feel like that's going to be a whole thing in the court system, right? Like how do you actively sue an LLM one of these models, and who's responsible? Is it the person
Yeah.
running it? Is it the person writing it? Is it
I,
the
I
person training
think
it?
so. The thing with the legal court system, I mean, I'm not a lawyer, but I mean, like logically speaking, the reason why people go to court is because there's a disagreement. And there's a disagreement about how, the way things should work. And so I think with agents, you kind of solve that problem where you can set up guardrails and structure things where you have determinism around how it's going to operate. And there is nothing to sue. Like if you give an agent a loan backed by its future cash flows, or like if it's not going to, like there's a way to structure this where it repays the loan if it has money, and if it doesn't have the money, it's not going to repay the loan. And that's the key differentiation between humans, because with humans, if they're supposed to repay the loan, they might not want to. And that's the sort of key factor where you can have a guardrails and determinism around following the debt covenants, we call it.
Well, yeah, no, I mean, I'll push back on, like it kind of sounds like it's moving, part of the transition into AI is moving more so into code as law, right? It's moving beyond even just there's even a human in any stage of it. And like the question would be is like, do you want this? Would be,
Oh, it's a philosophical question,
yeah,
right?
like almost like is like we face the problem of like is code law right now in DeFi, and there's all these arguments because like when something breaks or it doesn't go as intended and like it never actually works, or, it never actually plays out as intended, it seems. And like I feel like we're gonna have these learning and be learning these same lessons again with AI agents, right?
We might be iterating on these lessons, but by and large, these are very tractable problems that are going to be solved over time. Like, there's no
Sure.
reason why it's not going to be solved. Like, sure, we might make mistakes along the way, and we definitely have. Like, there have been many hacks over billions of dollars lost, but that's been going down. Like, it's improving, and so if you just plot that out, like these are all problems that are can be solved.
But is it going down? I mean, to me, it seems like like I think a lot of the protocols are hardening in the sense that like we're just not innovating as much on the protocol side. Like I would say, like, are we creating new primitives as much anymore? Probably not.
That's
Maybe,
why I'm excited about
maybe
3J.
you guys, yeah. Which is, yeah, me too. But then I would say the other thing too is like we've kind of like the old school model, like the makers or the early 2017 people who were launching DeFi projects. It was like you would never ever launch with an admin key or like like the ability to take user funds. Whereas like nowadays, like you guys, most people are like, of course we have guardrails. Are you crazy? Right?
Yeah. Yep. The sort of Overton window of acceptable protocol structure has slowly shifted,
Yes.
and it's been really interesting to see. And that's like part of the reason why 3Jane is like I think would work today and wouldn't work in 2021. Like in 2021 would probably be left out of the room. But it's been
Yeah.
funny to see because sort of like I remember a time where KYC of anything was just completely crazy to think about. And then treasuries rates went up to 5%. And Ondo was like, hey, we're putting treasuries on chain. Do you want to earn 5% risk free on chain? And people were like, fuck it, sure, sign me up. And they applied and did KYC. And that was like the first break. And then there was a break with Athena where it was like calling a custodied protocol DeFi was absurd. You can't say that. And then they're like, you know what? We're gonna do uh, a basis trade backed dollar, and we're gonna custody it, and like we're gonna do it. And people were giving them a hard time, and then now it's the status quo. So it's been funny to see the sort of Overton window shift.
Yeah. And I'm guessing you're you feel like it'll be under collateralized lending next, and then, what's the next thing? Like pretty soon it's almost like we just do whatever TradFi does. Like we're able to do everything on chain, it seems, right?
Yeah, I mean the idea is you get the best of both worlds.
Right.
And like some designs don't get that, but there is a way in like if you spend time on it to get best of both worlds. And so we think this is the best of both worlds where you get the capital information and the transparency and the disintermediation of the on-chain component while also sort of getting the legal recourse if it needs to come to that
Right.
of the off-chain part. And there is also like a whole thing around game theory of sort of on-chain repayment of loans that we think is really interesting that we've been exploring. But anyways, it's possible to do best of both worlds.
That's super cool. And yeah, I guess what are the plans going forward for tokens, governance? You guys are into DAOs, not
Um, I've never been big on DAOs.
never been big.
I've never been big on DAOs. I've been mainly focused on the financial innovation aspect of it. Yeah, the DAO part just seems nice in theory, does not work in practice. Like there are reasons why humans have evolved with hierarchies. Like I don't want to go down that path if I don't have to of like hardcore DAO. But I think some parts of it are interesting, so we're definitely going to explore it.
Cool. Yeah. And then I guess, is there anything I didn't cover on 3Jane? I think
Um,
it's the pieces we should go over.
no, I mean, yeah, novel DeFi primitive enabling unsecured lending in crypto, starting with borrowers, end game as agents. Yeah, I mean, I think we covered most of it. I think there's the interesting part with is around the game theory that we're thinking about is there's a guy called Virgil Griffith. He was big in the ETH community.
Yep.
He's going to be released from prison soon, but very smart guy. And he wrote this idea around how one of Ethereum's superpowers around game warping. It's the idea of taking any sort of game theory matrix, like the prisoner's dilemma or any sort of dilemma, and by having sort of like enforcement on chain, you can actually change the sort of equilibrium of that game theory. And we think it's actually very applicable for unsecured lending because one of the parts of our protocol is if you uh, if you default, there is an on-chain auction where U.S. collections agencies can bid on collecting that debt on a contingency basis. And we think the fact that there is a perpetual credible commitment of the fact that if you don't repay your loan after this block timestamp, it's going to trigger like four different collection agencies like buying your debt. We think that sort of threat is actually going to strengthen the opportunity cost of defaulting compared to off-chain alternatives. And we think that's a novel unlock by having unsecured lending on chain.
Nice. Yeah, like the game theory around it though would be like I think what you would still need to measure out what's the cost to train one of these things. Like if I'm a how do I create a wallet and get it enough reputation to get out a loan? And what's the cost there, right? Because I feel like there is some cost to create, or I guess if you have to do KYC, then it's also the cost of a fake identity. So like a fake identity and
Yeah,
that,
so,
and then
right. It's fake identity.
fake
Well,
wallet.
you need the bank account, and then you need to have a bunch of assets in your wallet. So you need the money in the first place. Um, and yeah, you need to have like most farmers have been around for 1 to 2 years. And so basically we're going to see if your primary wallet that you sign your message with they didn't do their first transaction in DeFi summer or like even 2 years ago, like we might not give you a loan. Probably not. Um, because it's like the risk reward isn't there. So it's gonna be very hard.
Do you loan to smart contracts too, or no, just EOAs?
We can lend to smart contracts, like if you have a Genosis safe or some weird
Okay.
smart
Yeah.
contract structure. Yeah, that's fine.
Well, those ones make it harder though, because then like e even the EOAs, you because like what you could do with a smart contract is like sell it, right? So you could
Yeah.
like sell your, like if I'm a farmer and let's say I farmed with 12 address or 100 addresses over the last,
Yep.
5 years, are you creating a market for me to sell these addresses?
Yeah.
And
And
it's
we think that market is gonna, that's a
yeah,
great question, and that's a very smart question. And we do think it's gonna, if 3chain gets big enough, there is going to be that market. And we're gonna have to figure it out.
yeah. Well, this is like one of my favorite studies was on the Idena protocol. Uh, Pooja Oliver, she wrote it, and it was on you got UBI every time you did like some captchas, right? And basically the end game was like you had like Indonesian sweatshops set up to do captchas to get the UBI,
Yeah.
and you're like,
Yeah.
like it's like the game theory doesn't play out how you think it will. It
Yeah.
like always,
Yeah. No, I'm very aware that this is going to create very perverse incentives.
yeah.
That like some of them I already know what are going to be, but some of them I might not even realize right now. But yeah, we're definitely going to see people. There might be this concept of farming your address
Yeah.
where you're building up your reputation on your address, then you're reselling it. Like I don't know. It's like stuff's going to happen.
Yeah, no, what'll be interesting, like how can you sell private keys? It's always a tough piece.
Yeah,
Uh,
it's like it's hard, and we
yes.
really don't think people like it might happen. It's going to be hard, but yeah.
Yeah. No, this was super fun. I guess where can people find out more about 3Jane and about you?
Yeah, 3jane.xyz. We're about to do a big push and reveal more to people about how this whole thing works and the structure and the architecture. So we're very excited to get more people involved.
Awesome. Well, thanks for coming on, Jacob.
Yeah, thank you.